Now friends, we discuss perfect competition, its features, its demand curve and its price elasticity. First, let us revise the features. There is zero product differentiation and zero advertisement, so non-price competition is absent. Pricing power is not there with the sellers. So many players, once again, many players means many buyers and sellers, right? Numerous buyers and sellers. Non-price competition means no advertisement, no product differentiation. Then very, very low entry barriers. These are the main features. Now coming to the demand curve. Demand curve means with the change in price, how does the purchasing behavior of the buyers change? So the demand curve here would look like this. Let's say the vertical axis is the price and the horizontal axis is the quantity or the demand. Then the market demand curve will look like this. We already know that the firm-wise demand curve is flat, right? For a single firm, the demand curve would be flat. That means for a particular price, whatever sales can happen. If there is a little increase in price, then no buying will be happening, right? And decreasing in price is also not required because the entire market is selling in that price. So the curve is flat. This is for a single firm. And for the entire market, it is a downward sloping line. Entire market, right? So this market, let's say, has 10,000 sellers. 10,000 sellers. Let's say it's a farmer's market. 10,000 sellers are there. Whatever commodity is being sold, the entire market's demand curve is downward sloping, which means as the price will go up, the demand will go down. Demand will come down, right? Demand will tend towards zero. If it is a non-essential thing, it will obviously tend towards zero. So this is the difference between the firm demand curve, which is flat, and the downward sloping demand curve, which is for the entire market. Both we are talking about perfect competition environment, right? Now, this demand curve, market demand curve, we will do some mathematics over it. So if you know, a downward sloping curve can be equated like this. Here, P is a function of the quantity. P is a function of the demand, right? Price is a function of the demand. And this function equation looks something like this. A minus B into Q. This is how it looks like. Price is equal to A some constant minus B some constant into Q, which is the demand. So price and demand are the variables. Demand is the independent variable or X, price is the dependent variable or Y, right? B is the slope, this is the slope, this is B, and A is the vertical axis coefficient. So this length, wherever this line intersects, the length here is A. When the quantity is zero, the value of P, whatever it is, that is at the price at which demand becomes zero, that is A. Okay. Now, what is the total revenue for any particular point? Let's say we take this point. What is the total revenue? The total revenue is this area, friends. Now this area means this price multiplied by this quantity. So total revenue is equal to P into Q is equal to, we already know this is equal to A minus BQ into Q, or AQ minus BQ square. Now what is the average revenue, friends? Average revenue is equal to total revenue by total quantity. So this is nothing but the price, friends. This is equal to A minus BQ. What is the marginal revenue, friends? Marginal revenue. Marginal revenue is the small change in total revenue which is represented by del TR that happens due to a small change in demand or quantity. So let's say the initial quantity was Q. It changed a little bit and became Q plus del Q. So this is the final revenue, which is total revenue plus the increased revenue or the change revenue minus the initial revenue, right? Divided by the change in demand or quantity. If we solve this, this can become, now this TR plus del TR is basically the total revenue when the Q is Q plus del Q, right? This is equal to A into Q plus del Q minus B into Q plus del Q square minus AQ minus BQ square, which is the initial revenue without the change in demand, divided by del Q. This is equal to, we can simplify it, and this becomes AQ plus A del Q minus BQ square minus B del Q square minus 2BQ del Q. This entire expression, let's do one thing, let's move it to the left side a little bit. This minus AQ minus BQ square, right? This entire expression divided by del Q. This entire expression divided by del Q. This and this cancel out, AQ and AQ, minus BQ square, this becomes plus BQ square, so they also cancel out. So the remaining expression is like this: A del Q minus B del Q square minus 2BQ del Q divided by del Q. So this del Q cancels out the del Q's here, one del Q here in each of the expressions, and this becomes A minus B del Q minus 2BQ, right? So the marginal revenue expression is MR is equal to A minus B del Q minus 2BQ. Now we talk about elasticity. Elasticity, we actually mean price elasticity. So elasticity, friends, means the percentage change in demand due to percentage change in price. Elasticity is the percentage change in Q due to the percentage change in price. And because if price changes, price increases, demand tends to decrease, we add a minus sign here. And elasticity is denoted by this symbol. This symbol is called epsilon. So epsilon elasticity, this is equal to 1 minus percentage change in demand due to percentage change in price. We can also write it this way. This is equal to minus of del Q by Q divided by del P by P. The marginal revenue MR has an interesting relationship with this epsilon. This is given by P multiplied by 1 minus 1 by epsilon. Now friends, a few things to remember about epsilon. Epsilon is basically the sensitivity of the change of demand with respect to the change in price, right? Now, if that sensitivity is very low, the product is called inelastic or almost inelastic. In that case, the curve will be something like this. It will be a vertical curve, which means that whatever price changes happen, the quantity remains constant, right? The quantity remains fixed. This can happen in case of essential goods, especially monopolistic and essential goods like fuel, like certain medicinal products, etc., etc. So this vertical thing can be there. Even if price increases, change in quantity does not happen, or does not happen that much. So this is an inelastic product per se. But as we said, in case of perfect competition, the line is rather different. It is flat. For a single firm, it is flat. That means at a certain price, whatever sales can happen will happen. But if you increase the price just a little bit, all the sales can go to your competitor and your sale may become zero. And also, you will not even decrease the price, because decreasing it does not even change the quantity sold, right? So this is the essential difference between a monopoly and a perfect competition. They are diametrically opposite in a certain way. Here the demand curve is vertical, here it is completely horizontal in ideal cases. Obviously in practical markets, ideal cases are not there. Slants will be there, noises will be there. Elasticity depends on a few things. One thing is the buyer's total buying budget. And the second thing is the price of the product. Right? So a product whose price is only 5% of the budget, total budget of the buyer, the sensitivity, the elasticity will be very less. That means my budget is total, let's say 10,000, and the cost of a certain product is, let's say, 500. In that case, elasticity will be much less. On the other hand, if it is 50%, so let's say I am paying rent, I am buying food, I am paying rent. So there is food, there is rent, there is non-essential purchases, right? Now let's say food takes up 5 to 10% of my expenses, of my budget, and rent takes up 50% of my budget. So elasticity of rent will be very high. Elasticity of rent will be very high, which means if the landlord says I'm going to increase the rent by 5% or 10%, you will think about changing your house. One will think about changing the house, literally. But if instead of 5%, the cost of food goes up to 6%, not much difference is felt. Not much difference is felt, right? This is what elasticity, buying budget and price of the product are related. Now, the elasticity that we were talking about so far was the direct product elasticity. Apart from that, there are certain other elasticities also, like income elasticity and cross price elasticity. First, let us discuss income elasticity. Income elasticity is the change in demand of a certain product due to change in income. So, income elasticity, epsilon I, is equal to change in demand of a certain product due to change in income. We are denoting it by I. Generally speaking, we do not add a minus sign here. It is a plus sign, because if income goes up, the demand of a product that we regularly buy or will like generally goes up. So they are directly proportional. So income elasticity has a plus sign to it. Then there is cross price elasticity. This is the change in demand of product Y due to change in price in product X. So elasticity XY is equal to change in demand of product Y due to change in price of product X. What this actually means, let's discuss. Let's say India is facing a certain amount of trade deficit. It is facing certain amount of trade deficit. And this is because they have to import large amounts of fuel or gas, right? Around 40 to 50% of India's import, let's say, constitutes of gas. I am a little off on my number, but it is an actual fact that a lot of imports proportion is due to gasoline or diesel or petroleum. The Indian government wants to reduce the dependency on petroleum. For that, what it does is it reduces the price of EVs through a subsidy scheme. electric vehicles in India become cheaper, the prices come down, right? So as the prices of EV comes down, the quantity of total petroleum consumption also comes down. Q of petroleum or gasoline also comes down. So this is what we mean by cross price elasticity. Price of something changes, because of which something else becomes less demanding or more demanding, whichever may be the case. So here EV is a substitute. EV is a substitute. Why it is a substitute? Because the product it is impacting negatively. Now if it impacted positively, it would have been different. So let's say due to the same uptick in the EV sales, the lithium ion battery sales go up. Lithium ion battery sales go up. Now this is basically because of a reduction in price in EVs. The lithium ion battery makers make a profit because the demand increases, because more EVs are sold and more lithium ion batteries are required. Now this is a complementary relationship. So cross price elasticity has two kinds of ways to it. One is negative impact, which is because of substitution. Another is positive impact, which is because of a complementary impact. EVs require lithium batteries, and as EV sales go up, lithium batteries demand go up, right? So this is about income elasticity and cross price elasticity. Friends, now we'll discuss a few things like economic profit, accounting profit, and later on supply and optimal output. So first let us discuss economic profit and accounting profit. What are the meanings of these two terms and what is the difference between their meanings? So first we will discuss accounting profit. Accounting profit is nothing but the numerical revenue minus the total cost that is incurred according to the accounting method or the balance sheet of the business. Let's say there is a business XYZ which in this year 2025 has earned $100 million and its total cost has been $80 million. Therefore, the accounting profit is equal to simply 100 minus 80, which is $20 million. Right, friends? Now, what is economic profit? Let's understand this. Let's say there is a business an investor is looking to invest in, and that investor has two options or three options. Let's say the investor has option A, option B, option C. Now, all of these businesses have a projected revenue of 100 million. Projected revenue of 100 million. And business A has a projected cost of 70 million. Business B has a projected cost of 75 million. And business C has a projected cost of 80 million. Right? 70 million, 75 million, 80 million. These are the projected or expected total cost. And these 100 millions are expected total revenues. Right? So which one should the investor choose, friends? It's easy, right? The maximum profit should be chosen. So option A should be chosen. Right? Now for this, a compromise has already been made. What is that compromise? What is that compromise? That compromise is the projected revenues of B and C have been let go of. So the investor thinks that A is going to give me the maximum profit, so I should let go of opportunity B and opportunity C. Now, the next best profitability. Which one has the next best profitability? The next best profitability is obviously business B. This is 25 million, right? This is the projected profit. Now, this has been let go of to avail the opportunity of investing in business A. Therefore, the opportunity cost is the opportunity of earning another alternative income that is let go of to invest in the current opportunity. So you choose option A and you choose the next best option B. This is your opportunity cost, right? And why am I talking about opportunity cost? It was about economic profit, right? So economic profit is nothing but total revenue minus the opportunity cost. Total revenue minus the opportunity cost. Now friends, we'll talk about supply curve and optimal output levels for a business or a firm. Supply curve and optimal output. So friends, till now we have compared price with quantity, right? Now this quantity is basically the demand quantity. We have to remember we have compared the pricing behavior with respect to the demand of a product, right? Now we will talk something about supply of a product, the relationship between price and supply of a product, right? So initially we saw that demand of a product, QD, demand of a product behaves inversely with the price, right? So it looks something like this. As the prices go up, the demand falls, right? Now, if we look from the point of view of a businessman, how does this thing look? The businessman is basically controlling the supply. The consumers are controlling the demand. The consumer represents the demand and the businessman or the producer represent the supply. Now, how does the supplier look at this? The supplier obviously would want to keep on adding more and more supply till the prices keep on increasing, or at least they do not increase. So this curve will look something like this. The supply and the price will be related like this. Initially, let's say the price is here and the supply is here. Now, the businessman or the producer decides to increase the supply and see whether price increases or decreases. Now, the supply is here. Let's say the price comes to this place. So the new supply point is here in this curve, right? Like this, the supply keeps on increasing here, 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 till the curve is upward sloping. Like it can be here, it can come here, it can come here, and form this upward sloping line till what point, friends? Till the point where the business or the producer is maximizing its benefits. Benefits as in its profits. So when the profits are maximized, the point at which profit is maximized is the point of optimal output. Right? Optimal output or optimal supply. So we spoke about supply curve, and the supply curve is leading us to the point of optimal output. Optimal output or optimal supply from a business or a firm or a market. Right? Now, how do we judge where that optimal output is? For that, we have to understand a few more things. Now, to understand what can be this optimal output point, we have to understand something called marginal revenue. Marginal revenue. Now, to understand marginal revenue, let's take an example. Let's say a business has certain output options. Output option 1, 2, 3, 4, 5 up till let's say 8. Let's say for option 1, the output is 100 units. For option 2, the output is 200 units. For option 3, it is 300. Like this, 400, 500, 600, 700, right up till 800. Now, this is the total output. This is the total output. Now, what is the marginal output, friends? Marginal output is basically nothing but the final total output minus the previous total output. So for option 1, we keep it 100. For option 2, it is 200 minus 100, which is 100. For option 3, again 100. That means 300 minus 200. Then option 4 is 400 minus 300, which is another 100. Like this, all the marginal outputs here are, let's say, equal to 100 units of output, right? Now let's say we assume average cost per unit for all these output options. Average cost per unit for all these output options, right? So for the option 1, let's say the average cost is $50 per unit. For option 2, that is an output of 200, the average cost is, let's say, 45. For option 3, that is 300 units, the average cost is, let's say, 40. For 400 units, let's say it is 35. For 500 units, let's say it is 30. For 600 units, let's say it's 35. For 700 units, let's say it is 40. And for 800 units, let's say it is 45. Now friends, we are seeing a pattern here. So friends, here we can see that up till option 5, the average cost went down. It went down, right? From 50 to 45 to 40 to 35 to 30. It bottomed. And after bottoming, from option 6, it again went up, right? 35, 40, 45. So friends, do you want your average cost to go up or go down? Obviously, you want it to go down. Not only go down, you want it to be minimal, right? Now, to understand what is the optimum cost that you want for your business, we have to find out one more metric, which is not the average cost per unit, friends, which is the marginal cost per unit. That is, when the units get added, that is after the initial option 1, when the other options get added, that is the next 100 get added and the next 100 get added and the next 100 get added, what is the cost impact of that addition, of those additions? This we have to ascertain. For that, we have to understand what is the marginal cost per unit. Marginal cost per unit for all these options. So the first one, will keep it at that. The second one, by adding the first 100, the marginal cost addition was total cost at 200 units minus total cost at initial 100 units divided by 200 minus 100, which is 100. This is equal to total cost at 200 means average cost into total number of units. This is 200 into 45. 200 into 45 means 9,000 minus total cost at 100 means 50 into 100. This is equal to 5,000 divided by 100. This is equal to 40. This is equal to 40. You can calculate alongside with me, friends. Take your calculator out. You can calculate it. The marginal cost for option 2, which is the first addition of units, first option of addition of units from the initial unit of 100, another 100 gets added for the first time. The marginal cost for this option is 40 per unit. So let me remove this entire calculation and I'll write 40 in the row. So here I write 40. For option 3, what is the calculation, friends? Total cost at 300 units minus total cost at 200 units divided by 300 minus 200, which is 100. This is equal to total cost at 300 means 40 into 300, which is 12,000, minus total cost at 200, which is 45 into 200, which is 9,000, divided by 100. This is equal to 30. So let me write it directly in the row. For option 4, the calculation is similar. Total cost at 400 minus total cost at 300 divided by 100. This is equal to total cost at 400 means 35 into 400, which is equal to 14,000, minus total cost at 300 is 12,000. 12,000 means 40 into 300. So this is divided by 100, and this becomes 20. So the marginal cost at option 4 is 20. Let me write it in the row. For the fifth option, what is the marginal cost per unit? By now the calculation is similar, so I'll just directly write it. This is 10. This is 10. This is 60. This is 70. So friends, we can see something very, very interesting here. From 40 to 30, the marginal cost goes down. 30 to 20, it goes down. 20 to 10, it again goes down. But from this bottoming stage, the next set of 100 unit output increase creates a drastic increase in the marginal cost. So this becomes 60, then it becomes 70, then it becomes right up to 80. Now we are approaching very, very close to the optimal point, friends. The optimal point of operation for maximization of profit is nothing but this point where the marginal cost per unit comes down to its minimum. Now friends, we have come very, very close to understanding that optimal output point, friends. For that, we have to take the next step, which is plotting the graph for the average cost per unit and marginal cost per unit. This is the output or Q, and this is the cost per unit. Okay, we will plot both marginal and average cost per unit here. So let us first calibrate it, friends. So it is 100, 200, 300, 400, 500, 600, 700 and 800, right? So let me write it here. 100, 200, 300, 400, 500, 600, 700 and 800. Now, let me also calibrate the cost line. 10, 10, 20, 30, 40, 50, 60, 70, 80. Let me write down the figures here. So 10, 20, 30, 40, 50, 60, 70, 80. These are the costs. On the vertical axis, 100, 200, 300, 400, 500, 600, 700, 800. These are the outputs on the horizontal axis. Now we will just do the plotting. First, we will draw the marginal cost per unit. So let us plot the numbers here. So for option 2, option 1 is, we will not touch it. Option 2 is 40, right? Option 2 is 40. So point will be somewhere here. Option 3 is 30. Option 3, 30. we put it here. Option 4, 20. Option 5 is 10. Option 6, 60. Option 7, 70. Option 8, 80. Now, we will draw the marginal cost curve based on these points. So this is the marginal cost curve, friends. Marginal cost per unit curve. Now we'll plot the average cost per unit curve. The first point is, the first one is 50. So we'll plot option 1, 50 here. Option 2 is 45. Option 3, 40. Option 4, 35. Option 5 is 30. Option 6, 35. Option 7, 40. Option 8, 45. Now friends, we will also draw the average cost curve. So friends, now we also have our average cost per unit curve. Now friends, one thing to note is the minimal point of average cost curve intersects with the marginal cost curve, right? So this intersection point is the minimal point for the average cost curve, average cost minimum. But this curve says that if you find a more granular point which is between option 5 and option 6, maybe a total unit of 550 or something, you will find an even lower average cost per unit. Right friends? So this is what this curve is saying us. Now, this is the cost curve. Friends, we have come tremendously close to us finding out the optimal output position for a firm. Now friends, the optimal output position of a firm is not independent of the market structure. So when we talk about optimal output, we have to find out not only the cost behavior, but also the revenue, the marginal revenue, and the price behavior for different market structures of a firm. So if the firm is in a perfect competition condition, it will be one way. If it is in a monopolistic condition, it will be another way. Oligopoly, another way. Monopoly, another way. So each of these 4 market structures and their respective marginal revenue behaviors, pricing behaviors, and optimal output positions, we have to find out separately. So first, what we do is we find out the marginal revenue behavior, the pricing behavior, and in conclusion, the optimal output position for a firm in a perfect competition market structure. So let's do that. So first thing we discuss is the dynamics of marginal revenue and pricing with respect to the cost curve assumed by us in a perfect competition market structure. So let us copy the previous curve that we have plotted. So friends, here the maximum average cost that we plotted was 50, right? So we will assume that in the short run, a firm can sell the product at 55 per unit. So let us draw the curve. 55 means the point is here. Now what does the price curve look like, friends, in a perfect competition for a firm? It is flat, right? It is horizontal. So it will look exactly like this. So this is the price per unit curve, right friends? And this is in the short run. We will see in a while how the long run curve behaves. Okay friends? Now, what is our ultimate goal? Our ultimate goal is to find out optimal output position or optimal output point, right? This is our ultimate objective. For that, we are trying to find out the cost curve, the marginal revenue curve, the price curve, etc., etc. Now, we have deciphered the cost curve and the price curve. What is the marginal revenue curve, friends? Marginal revenue is basically change in revenue due to change in output, right friends? Now here in a perfectly competitive firm, we can see that the price is constant. So del R would be equal to price, which is constant, multiplied by del Q divided by del Q, because here P is constant, P is not a variable. It will be P into del Q divided by del Q. So del Q and del Q cancels out, which means marginal revenue is the same curve as the price curve or the price per unit curve. So this price per unit curve is also the marginal revenue curve. It is also the marginal revenue curve. So same line represents both. Now we have found out all the three, the cost curves, the marginal revenue curve and the price curve. Now our goal is to find out the optimal output point. The optimal output point is the point where profit is maximized. For a profit-seeking company, ideally speaking, the point where profit is maximized is the point of optimal output. Right friends, I'll repeat once again. For a profit-seeking firm, always, irrespective of market structure, for a profit-seeking firm, the optimal output point is that point where profit is maximized. Now, what is that point? It is the output at which marginal revenue is exactly equal to the marginal cost. It is the output at which marginal revenue is exactly equal to the marginal cost. So friends, how do we find it in this graph? We have to find out the point of intersection. Again, the point of intersection between marginal revenue and marginal cost. So that point is easy to find, friends. The point is this one. Marginal revenue and marginal cost curves meet at this point highlighted in red. So this is the point of maximum profit or optimal output. So the optimal output will be just the output that comes when you draw a vertical line downwards into the output axis. Here is the point, friends. So in our case, it is coming just around 600 units. Right friends, it is coming just around 600 units. We have written 1, 2, 3, 4, 5, 6, 7, 8. They actually mean 100, 200, 300, 400, 600, 700, 800, right? So the point is coming just around 600 units, given that this is a firm operating in a perfectly competitive market structure. Right friends? Now how do you calculate the maximum profit amount? The maximum profit amount, how do you calculate that? So there is a very simple way of doing it. So friends, this point is just around the 600 mark, right? In our case, this point is just around the 600 mark. So the optimal output for this firm, which is operating in a perfectly competitive market structure, is around 600, just below 600. Now, at optimal point, what happens? At optimal point, the profit is maximized. The profit is maximized. Now, if we want to measure how much profit is that max profit, how do you calculate that? There is a very simple process, friends. Now, if you see this red line, this red vertical line, this intersects with the average cost curve at a certain point, right? Again, just below the 600 level, it is intersecting with the average cost curve, this line. Now this point, you draw a horizontal line onto the vertical axis. Now you have a vertical line, you have a horizontal line, and above this line, you complete your square with the upper bound of the price curve. What do I mean? The square would be like this. Now this new rectangle that you have drawn, this red bordered rectangle, is the area which represents the amount of profit. So what you do to measure it? You multiply this vertical dimension with this horizontal dimension, and whatever amount you get, let's say you get P dashed into Q dashed, this is the profit max point. This is the profit max amount. Now friends, one caveat is there. This is in the short run. In the short run, what happens is some extra profit is gained. A very renowned economist named Schumpeter, he has postulated that in a new market, always three phases are there. First, there is innovation. Then, because of this innovation, there is extra profit. Now, this extra profit attracts multiple players. So, there is proliferation or competition. And because of this competition, whatever excess amount of profit was there in the market is eradicated or eroded, and the market condition returns to perfect competition. Perfect competition as in there is zero economic profit. There is zero economic profit. Zero economic profit. What does it mean? It simply means that the marginal revenue in the long run, this will be equal to the minimal average cost per unit. The minimal average cost per unit. Now we already know that point, right friends? So we already know the average cost minimum point here, right friends? We will draw a horizontal line which will pass through this point. So let us draw that. So this is the long run price per unit, and this is where the company will operate, and this will also be the long run marginal revenue curve, right friends? So lastly friends, if we want to measure how much profit is being achieved, how do we calculate that? The calculation is very simple. Profit is equal to price per unit multiplied by number of units minus average cost per unit into number of units. This calculation prevails for all sorts of market structures. Now we have understood how the pricing and the marginal revenue behaves with respect to the cost curves, that is the average cost curve and the marginal cost curve, for a firm operating in a perfectly competitive market structure. Now we'll move into the next kind of market structure, which is a monopolistic competition. Let's see. Now friends, once again we have our curve and we have the market structure, which is monopolistic competition. Now friends, here, how is the price curve and how is the marginal revenue curve? Obviously it is not flat. In a monopolistic competition, the price curve is downward sloping. So let us assume that for 100 units, selling of 100 units, the price point is 80 per unit, and for selling 800 units, the price point has to be 52 per unit. And this price reduction happens in a linear fashion. That is, for 100, it is 80, for 200, it is 76, for 300, it is 72, like that. At 800, it is 52. So let us draw the chart. So friends, here the price per unit is not flat. So we'll have to draw a downward slanted line. Before we draw that, let us calculate the numbers at which the price points are for different options, friends. Now friends, in our existing chart, we already had these rows: total output options, marginal output options, average cost per unit options, and marginal cost per unit options. We'll add two more points here, which are price per unit and marginal revenue per unit. Right friends? So let's do that. So the price per units, we have already assumed that it's going to start from 80. For option 1, the price per unit will be 80. That is, for selling 100 units, the price has to be 80. And for selling 800 units, the price has to be 52 per unit. So in between, we divide it uniformly because we are looking at a linear reduction. So 80 76, 72, 68, 64, 60, 56 and then 52. So here we have the prices. Now we have to calculate the marginal revenue at each of these option points. So how do you calculate marginal revenue, friends? It is very simple, friends. Marginal revenue is total revenue at the current option minus total revenue at the previous option divided by output at the current option minus output at the previous option. So this is the way we will calculate it. So let's say for option 1 we'll give it up because there is no previous option here. Now for option 2, the total revenue at option 2 is price per unit into total output, which is 76 into 200. So this will be equal to 15,200 minus previous output, previous total revenue, which is 80 into 100, that is 8,000, divided by 200 minus 100, which is 100. So this is equal to 72. We'll write it here. And let us remove the calculation. The next one, total revenue at option 3, this is equal to 72 into 300. This is equal to 21600 minus previous total revenue, which is 15,200, divided by 300 minus 200, which is again 100. So this is equal to 64. Like this, we can calculate the marginal revenues for all these options. So this will be 56, this will be 48, then 40, then 32, then 24. So these will be the marginal revenues per unit at each of these options, option 2 till option 8. Now, by calculating these options, we have also done one more thing, which is we have calculated the points through which these plots will pass. So PPU and MRPU, marginal revenue per unit, these are both straight lines. So we'll draw these straight lines in the main curve, friends. The price curve starts from 80 at option 1 and ends at 52 at option 8. And talking about the marginal revenue curve, it starts at 72 for option 2 and goes down till 24 at option 8. So option 2, 72 till 24 at option 8, somewhere here. So let me draw this line. Now this is the marginal revenue curve and this one is the price curve, right, friends? Now here, do we have the profit maximal point? Of course we have, right? We have the point of intersection between the marginal cost and the marginal revenue. This is the point. This is the point. This is the point, right? So the optimal output is again a vertical line downwards from this red colored point. Now, how do we calculate the amount of profit at this optimal output? How do we calculate that? We draw a vertical line upwards from this red point till the price curve. And just like before, we draw the rectangle. So friends, this red rectangle that we have drawn here, this one, this is going to be our profit max amount. Right, friends? This is the amount of profit. This area denotes, this area which is bound by these two dimensions. One is the horizontal dimension and one is the vertical dimension. This area represents the amount of profit at the profit max point. Now this is in the short run, friends. This is in the short run. What about the long run? Let's discuss. So friends, we are going to find out the condition for optimal output in the long run for a firm operating in monopolistic competition. So this is the long run version. Now in the long run version, what is the condition for the price curve or the marginal revenue curve with respect to the cost curve? So in the long run, what happens in the case of a monopolistic competition? What happens is the price curve becomes tangential to the average cost per unit curve. Tangential means if there is a curve like this, a tangent will mean a line which just brushes across at one point with this bent curve. So this is exactly what we are going to point out in our selected graph. So let's do that. So friends, in the long run, if the option 8 starting price is 80 and we have to draw a line which is tangential to the average cost per unit curve, the line would brush from somewhere here. So if we draw a line passing through these 2 points, we have our required price per unit curve. So let's do that. So this is the price per unit curve, friends. Now, if this is the price per unit curve, the marginal revenue curve will also be a lot more vertical, a lot more steep. So this will be something like this. So this is the price per unit and this is the marginal revenue curve. Now, what is the optimal output, friends? It is still the intersection between the marginal cost and marginal revenue. It is this point. Now please note, the minimal average cost point is not reached by the price, right? The minimal average cost is here, shown by this red arrow, but the price in the long run reaches till this point, which is above this minimum point, right? Yes. But on the other hand, at the minimum point, the output will be nearby 600. It will be somewhere here. But in the long run, for the monopolistic competition, the output is somewhere around 250. Somewhere here. Right, friends? So the output decreases. The price does not reach the minimum point of average cost, but the output goes down. And this obviously has an impact on the total profitability. How do you measure the total profitability, friends? Obviously, you draw a vertical line upwards from this point of intersection of the marginal cost and marginal revenue. It hits the price point at this point, which is shown by this red arrow. And we have to complete the rectangle to find out the area of the profit. So this new rectangle which we have formed is the new profit area in the long run. So now we have understood the long run and short run marginal revenue and price curves for a firm operating in monopolistic competition. Now what we need to do is take the next market condition, which is oligopoly, and try to find out what are the pricing, revenue and cost dynamics for a firm operating in that condition. So friends, for an oligopolistic market, the pricing dynamics have to be measured based on 3 strategies. One is assumption of pricing interdependency. Second is the Cournot's equilibrium. And the third is Nash equilibrium. Let us first start with pricing dependency assumption and strategize the price accordingly. An oligopolistic market. Oligopolistic market means there are only handful of players, like 2 players, 3 players, or 5 players, like that. And the product differentiation is not much there. There can be price wars, or on the negative side there can be collusion also, which we'll talk about later. But right now we will assume that there is a healthy competition between the participants. For example, the Indian telecom industry, I have taken this example before also. There is immense amount of competition between the players, although there are only 3 players. Only 3 players, but still there is immense amount of competition. So what happens in a oligopolistic market is that if there are price wars and healthy competition, what happens is the markets react much more to price increases negatively than they react positively to price decreases, which means elasticity of decrement is less and elasticity of increment is more, right? Elasticity of decrement is less and elasticity of increment is more. So this basically means that if the price is changed by del P downwards, then naturally del Q moves upwards, and if the price moves upwards, del Q moves downwards. But the difference in sensitivity or elasticity means that the demand upwards is less than the demand downward. Same price, let's say 5% price change has happened. If it happens upwards, there is a lot more decrease in demand than the increase in demand, which happens due to a decrease in 5% price, right? So now let's do one thing. Let's divide both sides by del P. Del P, del P. So what we have here is 2 different demand curves. When the price is moved upwards, this is the demand curve, the right one. And when the price is moved downwards, this one is the demand curve, right? What is the difference, friends? We know del Q and del P is the slope. Now, slope of price increases is more than slope of price decreases. How will these 2 slopes look like? Let's try and understand. Let's say price is on the vertical axis. Now, because of this much price change, which is shown by this vertical line, a change in demand happens, which is, let's say, this much, right? So the slope will be like this in this case. So this is P and this is Q. Now for this one, again the price change was same. It was this much only. And due to this price change, the demand change was only this much, not this much, unlike this one, but only this much. So the slope here will be much more than the slope here. So we draw the slope, my friends. So the slope due to price decrease will be much more than the slope due to price increase. Right, friends? Slope due to price decrease will be much more than the slope due to price decrease. So we'll draw the slopes right now. So the price decrease demand curve will be much more steeper. So it will look something like this. And the price increase demand curve will be flatter. This one will be flatter. So this will look something like this. And naturally, the marginal revenues with respect to increase and decrease will be like this. This is the marginal revenue line with respect to price increase. And this is the marginal revenue line with respect to price decrease. So let me write out. Demand curve due to price increase, marginal revenue curve due to price increase, demand curve due to price decrease, marginal revenue curve due to price decrease. Now friends, there is, as you can see, there is a kink in the curve. The kink is there because at the prevailing price, depending on whether price increases or decreases, the curve selection will change. So if the price decreases, this green line will show the demand curve path. And if the price increases, this red line will represent the demand curve path. And respectively, the marginal revenue lines also will change. So let me draw the kinked curve as an overlay of this. So friends, if price increases, this red line will be the marginal revenue curve. And if the price decreases, this green line will be the marginal revenue curve. But the problem is there is a gap here, right? There is a gap here. So how do we maximize profit here? The way to maximize profit is basically minimizing the marginal cost. So let's say initially the marginal cost curve is like this. Initially the marginal cost is like this, MC1. What the firm can do is reduce it further to the point where it touches the green line. Now, this is the minimum profit at prevailing price. At prevailing price. Let's say this is prevailing price represented by P dashed. And this line represents maximum profit at prevailing price. See friends, this difference that is there in the cost, if that is fully utilized, then the profit can be maximized at the prevailing price. So here one has to understand the profit maximization is subject to the prevailing price. So this is how oligopoly works. But one point we have to understand is this calculation we have done is based on pricing interdependency postulate. Pricing interdependency postulate. That the postulate says that the incumbent participants, the participants in an oligopoly, will reduce prices imitating the other competitor, but will not increase the prices likewise. So the players, let's say there is player 1 or player A, player B, player C, they will reduce prices imitating the other. When the other reduces prices, they will also reduce price. But let's say one of them increases the price, the others may not increase the price. So this is the postulate of pricing interdependency, right? Now, to understand the pricing strategy and the dynamics of an oligopolistic market, there are two other ways to look at it. One is Cournot's equilibrium and the other is Nash equilibrium. Let's understand what they are. Cournot's equilibrium strategizes prices with one assumption. The assumption is the output of the competitor is constant. The output of the competitor is constant. Based on this assumption, Cournot's equilibrium decides the price. So to understand this, let's look at a very simple example of a duopolistic market. Let's say the total demand in the market is a sum total of the two players in the market, which are A and B. So QA and QB. This is the total demand, and these two. And let's say A is trying to decide the pricing. A is trying to decide the pricing based on the assumption that B's output will remain constant. Now, how does A decide on what the price is going to be? For that, A will need to know two things. One is the marginal cost, and two is the relationship between price and the market demand. The relationship between the price and the market demand. So let's take a few assumptions here. Let's say price is equal to 1000 minus QM. This is the relationship between price and the market demand. So this part is now known. Now the second thing is, let's say marginal cost. Marginal cost is equal to 50. Marginal cost is equal to 50. And because there is not much product differentiation, we would say marginal cost for both A and B is 50. Now, this is one equation. This is another equation. And the third equation is QM is equal to QA plus QB. This is the third equation. Now, based on these three equations, we will try to understand the price that A should sell at. From these three equations, friends, we can derive the total revenue of A and B. So total revenue of A is equal to P into QA. This is equal to 1000 minus QM into QA. Now QM is equal to QA plus QB. So we can write 1000 minus QA minus QB multiplied by QA. This is equal to 1000 into QA minus QA square minus QA QB. Similarly, total revenue of B is equal to P into QB. This is equal to 1000 QB minus QB square minus QB QA. Right, friends? So this is equation 4 and this is equation 5. For profit maximization, the condition is marginal cost should be equal to marginal revenue. So for profit maximization of A, marginal cost of A should be equal to marginal revenue of A. Now, we can derive the marginal revenue of A by differentiating total revenue of A with respect to Q of A. You do not need to worry if you do not know calculus. The result I am writing here, it is going to be exactly this if differentiation is done of total revenue with respect to quantity or demand of A. So this is equal to 1000 minus 2QA minus QB. This is equation 6. Similarly, marginal revenue of B is equal to differentiation of total revenue of B with respect to QB. This will also, if you do the calculus procedure, it will come to 1000 minus 2QB minus QA. Now, from equations 7 and 6, we have got the marginal revenue of A and B. Now we already know marginal cost of both A and B. Of both A and B are equal, which is equal to 50. And for profit maximization, marginal cost of A should be equal to marginal revenue of A, and marginal cost of B should also be equal to marginal revenue of B. So we are trying to decide the price at which A will sell, but the catch is this: in an oligopolistic market, which is basically a duopoly, the equilibrium price for both A and B will be the same. If both of them decide their pricing based on the assumption that the output will remain constant. So under Cournot's assumption, PA and PB in equilibrium condition would be same. So from here we can easily derive what is PA and PB. Let's see how. Now, MRA is equal to MCA, which is equal to 50. This implies 1000 minus 2QA minus QB is equal to 50. This is from equation 6. And MRB is also equal to marginal cost of B, which is also equal to 50. This implies 1000 minus 2QB minus QA is equal to 50. Now we can modify this equation. This equation, let's call it equation 8 and equation 9. We can modify equation 8 by multiplying both sides with 2. So this becomes 2000 minus 4QA minus 2QB is equal to 100. Now what we do is we do 8 minus 9. So we do equation 8 minus equation 9. So this becomes 2000 minus 4QA minus 2QB minus 1000 plus 2QB plus QA is equal to 150. So 2QB and 2QB cancel out. We have 1000 minus 3QA is equal to 150, or 3QA is equal to 850, or QA is equal to 850 by 3, which is 283.3, which rounds off to 283. So QA is equal to 283. If you try to find out QB, this will also be possible in the same manner, and the value will also be equal to 283, right? Therefore, QM is equal to 2 into 283, which is 566, right friends? Now, how do we decipher what will be PA, right? What will be PA? Now we have already said that PA should be equal to PB under Cournot equilibrium. Now A and B are the only players in the market. So this is also the market price, which is P. And we already know the relationship between the market price and the market demand. P is equal to 1000 minus QM. This is equal to 1000 minus 566 is equal to 434. This is equal to PA or PB. So under Cournot equilibrium, the pricing for A and B both is 434. Right, friends? Now we'll move into the next method of strategizing, which is Nash equilibrium.
Thank you so much friends for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships and CFA curriculum classes, check the description below. Till then, keep watching Finnovation. See you in the next class.